What's going on, everyone? Jeremy here from The Quartering. I hope you're having an absolutely wonderful day. I know I am. It's Friday, leading into the weekend. I should have a few videos for you over the weekend as well, but I hope you would take some time to relax and enjoy. Netflix loses over $20 billion overnight in market cap and continuing to fall after new announcements, vulnerabilities over the Hollywood writer strike, underperforming, and woke garbage in general on top of that. Let's take a look at this story. If we start first with the Netflix stock, it has been basically on an incredible rally over the last 6 months, peaking at nearly $500 a share. Some of this obviously could be some sell-off and profit taking, but if we look over the last 5 days, it has absolutely plummeted down $17.10 a share. Today alone, it's down another $10 a share, just absolutely plummeting. And this is partly in relation to their new profit center, their new profit reporting. But how do we get here? Well, the Netflix password crackdown that pissed off customers actually worked. This article here on Tech Radar says, hate to say I told you so, but the unalloyed success of Netflix's password sharing crackdown is surely the beginning of changes across all of our subscription accounts. If you've been sharing accounts with friends and family for anything from Amazon to Hulu and maybe even the New York Times, expect all of them to start tracking and blocking logins that are not from members of your paying account, family, or location. I'm so certain of this, I convinced myself the other evening that the global cross-category crackdown was already underway. After a long day of work, I settled in for a relaxing evening of streaming. But before I could begin, my wife informed me that we've been logged out of Hulu. No big deal, I thought. I figured we'd log back in, using it with my mother-in-law's premium account. My mother-in-law does not live with us. She's hundreds of miles away upstate, and a cold chill traced my spine as I realized we might not be able to log in again. Had Hulu also enacted password sharing? I wondered. We knew we hadn't covered such news on Tech Radar, but what if we missed the press release? Anyway, they signed back in, and hey, look, I actually am fine with, password sharing I understand why it's done. I understand why people are mad about it, but I also understand why it's done. Yesterday, or the day before, Netflix now canceled its basic plan. So there's no longer the kind of $10 a month basic plan. They're essentially raising prices by forcing everybody who used to be in the $10 ad-free category to now pay more money. Yesterday, they had an earnings call. Some of the highlights, of course, is that Netflix added 5.9 million subscribers. Heading into the earnings report, investors were curious how much of the company's crackdown on password sharing would boost sub growth. Well, it was 5.9 million people. Just 1 year after it had lost nearly 1 million subscribers, expect Netflix, which now boasts 238 million global subs, to keep benefiting from this password sharing clampdown. Yes, that's great for them. But Netflix did miss on revenue, with stock down 8% as Wall Street remains concerned about the streaming profits that are plaguing the industry at large. Analysts said that disappointing profits suggest new subscribers are choosing Netflix's lower price plans. But it's worth noting here that Netflix is still in its own league, having built a profitable streaming model. Sure, but getting rid of the $9 plan, obviously ahead of their earnings call, Netflix cut its cheapest ad-free option in the United States and the UK. The plan offered at $9.99 is no longer available to new customers. The decision to cut the bare bones plan appears aimed at pushing subs in that tier toward the ad-supported model, which is at $6.99. The company had previously said ad-supported model performed better on economics than the $9.99 ad-free model, which means they're selling enough ads to generate more than $10 in revenue, essentially. That said, this is kind of the future greed we saw yesterday. YouTube Premium had a huge price increase, and that's a sign of things to come, to be honest. You see this. Zach Moronstein said, I'm no economist, but Netflix lost $18 billion in value yesterday, enough to fund every single ask the writers and actors made for 36 years. Well, to be honest, that's not why it dropped. the Netflix is actually one of the only places that has so much backlogged content that they're relatively insulated from any kind of content drop off due to this writer's strike. But it's interesting. You see, to all the blue checks telling me I don't know how the stock market works, I want you to know you're right. You're strong. You're beautiful. I think that it's interesting that you see this continuing to drop. Wow, it dropped even now. It's down $10 a share today. There's a lot of pullback. But how Netflix can end the Hollywood strike in a way Disney and Paramount can't afford. Why would they pay for that? Netflix earnings report on Wednesday sent its stock tanking. But the first question on the company's post-earnings Wall Street analysts call cut to the chase of Hollywood's biggest issue. Will the world's biggest video streaming company let Hollywood's ongoing strikes by writers and actors interrupt its business, just as the company is turning into a true profit machine? Some analysts are quietly suggesting that Netflix won't. Even as most people focus on the fact that Netflix has a big inventory of content that it could let it ride out a long strike, its burgeoning financials suggest other possibility. The Netflix will, in the months to come, drive a nascent streaming industry where nearly all of its rivals are losing money towards a deal that Netflix can afford, but rivals can't. Netflix spent years tolerating losses and later burning cash to build up its library of Netflix-produced content, betting on the day which it would get big enough to generate big returns on that investment. The second quarter results were released Wednesday and are the least of it. The most bullish analysts on Wall Street think profits could be more than doubled by 2025, with even average estimates saying profits will rise to $8.3 billion from $4.5 last year. After the report, now analysts speculate Netflix will, in the months to come, force a settlement to the strike by the Writers Guild of America and Screen Actors Guild of American Federation before its rivals can get back to business. Their theory isn't based on inside information, but the logic that Netflix is expected profit. So Netflix will be able to say, hey, we're going to pay. We'll pay for this. It's actually genius. And what we saw yesterday, or a few days ago, that Disney Plus is hemorrhaging subscribers. And it's no surprise. Now, if we look at the Netflix stock, it's down. It's creeping back up a little bit today. But if you look at Disney Plus, they have done nothing but lose subscribers, and it's a result, honestly, of poor quality entertainment. I mean, that's quite frankly the truth of it. And Disney, nobody talks about Disney Plus. Very few people talk about Hulu. I have Hulu for live TV, but I only use it for. I used to only use it for sporting events, but now I have Bally's, so I can watch Brewers and Bucks games anyway. And I don't need to pay $100 a month for Hulu. You see this back in May. Disney Plus sheds 4 million subscribers in second straight quarterly drop. Streaming losses narrow by 26%. Here, record decline why Disney lost another 4 million. I'm sure they're going to have another report coming up soon where they lose more and more. And this is, Disney Plus angers subscribers after pulling original sci-fi movie less than 2 months after release. They can't afford it anymore. Everything at Disney's currently for sale. It's going to be interesting to see. Netflix stock sinks as Wall Street looks for clarity on revenue growth. The sell-off of Netflix shares follows a 60% year-to-date rally spurred by the rollout of its cheaper ad-supported plan and a crackdown on password sharing, both of which were supposed to drive growth for the streaming giant. Netflix offered few details on the initiatives Wednesday in its quarterly report. Its second quarter revenue fell short of expectations. I think people expected a lot more revenue growth in the third quarter. Plus, there was this weaknesses in average revenue per membership, said analyst Michael Nathanson. So Wall Street wants Netflix to make even more money off of you, which means they're going to continue to raise their prices. And, as our purchasing power, as our dollar continues to get weaker and weaker, thanks to our genius president, people are going to make cuts. I don't think you can keep pushing people and increasing these prices. You had YouTube Premium increase their price like $5 a month. Disney Plus hemorrhaging subs, still increasing prices. Netflix increasing prices. Hulu increasing prices. Everybody's increasing prices. Eventually, people are going to say enough is enough. Right now, I'm sustained by just renting movies that I used to enjoy on Amazon Prime. Here's what I do. Everything I order from Amazon, I take the extra ship it later to give me $1. They have an option where it's like, oh, I'll take it a few days later, and if they give me $1. The amount of things that I order from Amazon, every week I have like $10 in digital credit, which allows me to rent 2 to 3 movies a week for free. And that's what I do. And I want to watch something. I'll watch Sandlot, or I'll watch Jaws, or I'll watch High Fidelity, or something like that. Because I just don't care. I don't care to spend all this extra money. If I didn't have to consume some of this content for my channel, I probably wouldn't have any of these streaming services. Dead set. I just wouldn't have them. They're too expensive, and their value is just too little. And plus, they hate us. So it's interesting that it's interesting what you're going to see. I suspect you're going to see more price increases because Wall Street just wants more money, and that's what drives all these wild decisions. Streaming's in a really, really tough spot, and I suspect not all of these companies will make it out of it. I hope you enjoyed this video. If you did, please do leave a like on it, and we'll talk to you again real soon.